Welcome back, everyone. Today's video is going to be on the topic of the US dollar. Is it going higher? Is it going lower? Why do people think A or B? And what are some of the arguments that are floating around out there? And I know, you're probably thinking you don't make many extra videos, especially around this time. Why, with your time, are you spending it making this video that nobody's going to want to watch? And I understand. I understand that thought completely. I just think that this is a very, very important question that really is critical to be understood, the arguments in order to look at what's happening in the world. So that's why I'm doing it. I've had it on the docket for a while, but I'm finally getting around to narrating it and finishing it. So I think this is a very important question for investing, and I think it is possibly the most important question in investing. And I'm sure a number of you understand the extent to which it can affect the directions of markets around the world. But I feel like there would probably be a lot more conversation in the comments about it if it was clear why I think about it as such a critical issue. Because there's not much discussion about it. There's discussion about a number of other things, which I see more as residual of the direction of the dollar. And I honestly believe that if you could tell for certain the direction of the US dollar going forward, let's say 1, 3, 5, 10 years, you could drastically improve your returns. Like I'm talking probably more than double once you filter that down to the risk markets. Unfortunately, it is a very complicated question to try and answer. There's a lot of factors, and I will be getting to hopefully a lot of them. Not all of them, because there's derivatives of factors that I won't be getting to today. This is intended to be a brief overview of some arguments, and I will just look at both sides, both some cases on both sides, um, to debate the direction of the dollar, and likely will not get to an answer here. This is mainly for you to look at this argument, see what makes sense to you, and maybe there's something on the other side that you hadn't thought of, and that's the point of this video. Okay, so let's first start with a well talked about bear case. Now, this shouldn't come as a surprise to too many people, but the US government is not in such a great space fiscally. Some people might call it broke, and some people might have a point. You don't have to uh, take anyone else's word for it. You can just look at uh, usdebtclock.org, for example, and you can see the fiscal situation literally deteriorating in front of your eyes. Now, that being said, this has been happening for a while, and it just keeps getting worse and worse and worse, and at some point, it will get exponentially worse, and has been, and that may continue. And if you were to extrapolate out down the line, eventually, all the spending covered by tax receipts, that is, would go to paying interest on the $22 trillion debt, the military, and the entitlement pay-go. And this problem is approaching. Now, can there be things done to avoid and kick the can down the road? Absolutely. For example, if interest rates were to be going down to zero or negative, well, then the interest expense gets easier to pay for. But again, doing so would, in theory, weaken the US dollar. So you have that counteracting the point. But the point is where we are now, we're getting to a point where the compounding of the issue is starting to become a problem with the interest and the deficits rising even as a percentage of GDP, and they are already north, or they're already around probably north of 100% of GDP in terms of debt. Now, could the US go to negative rates? There's a lot of debate on that. But realistically, there's some logistics questions, but it's quite possible that the Fed is already looking at the possibility of negative rates in the US. Depends who you ask. But this is just a looking down the line question. But basically, from here, this bear case is the US is getting broker by the minute, and they have to cut rates, which will weaken the currency. So basically, in order to fix this first bear case of the US fiscal situation being rather concerning, the US would have to cut rates all the way to that above 2% now to 0 or even negative. And now this is where we get to the first bull case of the moment, which is interest rate differentials. So when you look around the world at developed, safe, rule of law countries that you would feel comfortable investing in, you can get more interest on the US dollar than many, if not all, of the fully stable countries that you would want to lend money to and would not feel that you're putting your money at risk, either of inflation or whatever perceived risk you see. Now, right now, also you get the benefit of a stronger economy, which is also allowing for the higher rates. But the point is, if you have US dollars, you're seeking no risk. I'm using air quotes there, but you can buy government bonds that actually pay something, and you're not guaranteed to lose money if you hold the bonds to maturity, which you are in most places in Europe. And so you actually get some return on your US dollars. So even now, at the prices of the US dollar that have appreciated in recent years, if you were to look at what you can get with the US dollars versus what you can get with other currencies, the bulls would say the US dollar is even now really undervalued. So here's where the debate gets interesting. Because remember the first point that interest rates, having to pay interest on the rather large amount of debt that the US does carry, is what is the key driver of this rapidly deteriorating fiscal situation. The way that the US would go about fixing this or saving this would be to cut rates. Now, saving money, not necessarily saving the situation, because unless the rates are kicked to negative and the situation is starting to reverse, then it is just kicking the can down the road. Now, could the US issue trillions in negative yielding debt? Would there be enough demand? Well, that is another question. There's also questions about the feasibility about having the center of the financial world on negative rates. Can it be done? Other question. But the point is, the US is now looking at the situation and being like, well, why do we have to pay interest on our debt when all of the other, well, many of the other developed countries do not and are basically slowly defaulting on their debt. Well, not slowly defaulting, but having the system set up in a way where they get to pay back less than they borrowed. So we can define that however we want. But the problem is, once you go to 0 or negative rates, as well, the US wants, some in the US, high up there, if you will, want to cut rates to zero or negative. But once you do that, it becomes mathematically harder and harder to ever get away, because if you're paying 1% and it costs you $100, for example, to service that debt, then at 2%, that's $200. So your cost of your interest cost doubled getting from 1% to 2%. And if you look at that in reverse, if you're paying $100 at 0.5%, then getting to 100 or getting to 1 makes it 200. $100 at a quarter, well, 1 is 400. And once you begin to treat low rates as the new normal, the longer you're down there, more debt piles up, the harder and the less likely that you're ever able to get to what was historically normal rates. Now, this all is based on the premise that there will be never inflation again for the rest of time. And that, if you look at history, seems unlikely, especially when you have central banks and sovereign powers all over the world that want inflation to inflate away or the real value of debt, or alternatively, grow out of it. Now, this is also problematic because once you have too much debt, and it becomes difficult to grow. But this is a rabbit hole that is not the central part of this video, so I'll move on. So the next point I've seen some bears make about the dollar is that if you look at the trade weighted index, or different indexes, I've seen people point to the Big Mac index, which is basically the cost of a Big Mac in different currencies. Fun little index. But anyway, the point is that the US dollar is fundamentally overvalued when you look at what you can get with it versus other currencies in trade. So this is an argument, and it, you can look at charts to see it. And so the argument here is that the US dollar is fundamentally overvalued in a way that if you're a value investor, you might see it. Now, as we have said, the dollar has been moving higher for a while. And if you look out at what that can cause, the strength of the dollar has the ability to, in certain ways, break the world. Now, of course, I'll get into what I mean by this because it is a big statement. But if you look at different currencies, many from like emerging markets and countries and what's happened there, you can kind of see to degrees that the strength of the dollar has caused problems. Now, why is this? This is because different countries all over the world use the dollar in trade and in financing big projects. So, are you in Turkey and need oil? Well, oil around the world is purchased in US dollars. Now, are you in somewhere in Africa and you need to build a copper mine? Well, you finance that in US dollars. So, as the price of the US dollar goes up, the price of servicing the debt or of buying things goes up along with it for everyone else in the world. So as the price of things goes up, demand goes down throughout the world because of higher prices effectively, even without them moving in the US. And so this drop in demand, higher prices, has a snowballing effect, which can cause some serious issues. because there's all this dollar-denominated debt that is financing the world. Now, why do I say that the problem of a higher US dollar snowballs in that it gets bigger and bigger as it keeps going? Well, the price of the US dollar goes up, the demand goes down, um, and so the profits or cash flow of companies that would be paying back their US dollar debt, their cash flow is not where they thought it would be. And oh, yeah, the value of this US denominated debt is increasing with the strong dollar. So, as things get worse and the need for deleveraging gets higher, well, that deleveraging itself becomes exponentially harder. So, everyone throughout the world has US dollar denominated obligations. So, when things are more difficult in the economy, when there's an economic downturn, this problem becomes accentuated because the basis of debt is that it has to be seen to uh, before you can grow assets. So, as if there's problems in the economy, you still need to pay your debt. So, you still need US dollars. So, you have this system that's set up like that. And then you have the fact that foreign banks, particularly in Europe, have been issuing US denominated debt all over to entities which now need to pay back US dollars that were in short supply to begin with. And if you want to um, hear more about that, I suggest looking up the euro dollar system, which is quite complicated, but something that's extenuating the shortage of US dollars worldwide um, in times like these. And then you add to all of this Tariff Man. Basically, the US president who has been fighting against the system of trade, basically making trade uh, for other countries more difficult. And so normally US imports um, was the key source of US dollars for countries all over the world. Now, if this is becoming more difficult, then the dollar shortage, which has been structurally in place for a long time now, gets worse because the goods are having more trouble entering the U.S. in exchange for U.S. main export of U.S. dollars. Now, how did things get so bad? Well, there's a lot of reasons that kind of compiled themselves. The first, well, not necessarily the first, but one big one is that if you look at a decade of financial engineering and low rates, basically, are rates kept at zero or thereabouts throughout the world. This has caused a dependence on this financially repressed system because when rates are at zero, it becomes much easier to pile on debt because of the math I mentioned before, where you can borrow up to what you can pay back. So being at zero for a long time, the debt has grown much higher than it was before. The second reason is the end of the petrodollar system. Now, for a long time, the US was heavily reliant on oil imports, which means they bought foreign oil by sending dollars out and getting oil in. Now, what happened here is this was a flood of US dollars that was released into the world, I guess you could say. So this meant all the world gets or money gets out of the US in a big way and oil gets in. Now, this was a stream that basically funded the world with the world's reserve currency. The U.S. something the U.S. needed and something the world could then get their reserve currency to spend amongst itself. Now, what happened recently, or with shale, the shale revolution, is the U.S. started producing enough oil for itself, which meant this reliance on U.S. dollars to provide liquidity for the world kind of was slowly shut off. So the rest of the world was cut off from its funding, and in a slow yet steady, then all at once way. And so basically, the world was a junkie that was just cut off from its addiction, I guess is one way of putting it. So if it is this squeeze, basically, that's driving the short squeeze that's driving the dollar higher, could it end itself naturally? Sure. Is it likely to be helped by something like QE or MMT? So maybe, but I think that the results of QE or MMT would have drastically different implications for the meaning of the US dollar. I think they probably both would do their parts in trying to weaken it, but depends on how they're implemented, that could lead to drastically different resolutions of this problem if this is what's driving the dollar higher in the current landscape. And exactly how that would go is probably maybe a topic for a future video, but not really fitting here. So, in conclusion, the whole picture is complicated because every time central bank A cuts, central bank B then cuts more to make their country competitive, and then central bank C that is might start QE, and so it's the whole thing is a mess, but a very important mess to understand because, as I said to begin with, it's very important to have an idea of what's happening with the US dollar. And so while this video isn't meant to provide an answer, because truthfully we can't really know what's going on with the US dollar until it happens, this is just meant to look at where the dollar could be headed, some arguments on either side. Where do you think it's headed? Love to hear about that and love to hear about why. Personally, I am just a long-term currency bear because I look at long-term charts and that is very clear. But in the meantime, we live in the world of big fluctuations between currencies and anything could happen. Currencies can appreciate. So we'll have to see how this situation plays out. And with that, I will say thanks for watching, everyone. I just wanted to cover a bunch of topics briefly, not in too much depth, and I would love to hear what people are thinking with regards to the direction of the dollar and why, what theory speaks to them. And that is it for today. Have a great day.